Hi, everybody, and welcome to the webinar. My name is Clay Malcolm here at Advanta IRA, and I'm fortunate enough to be joined by Troy Eckard today. Troy, how are you today?
I'm really good, Clay.
Good. And for those of you who don't know, Troy is a mineral rights expert, oil and gas expert, longtime real estate investor, et cetera, et cetera. And so he's going to share some of his insights with us today about investing in that energy space and kind of what's going on in that world. I'm going to take the IRA part, and obviously the theme of today's presentation is that you can combine your IRA's tax advantages with the returns that you can make in the oil and gas, the mineral rights industry. And so that's going to be where we're melding things. And again, happy to have Troy's expertise here today. A little bit of housekeeping. So if you do have questions, go ahead and type them into the questions box, and we'll take those at the end. And you know, I'm gonna take about probably 10 minutes or so, give you kind of an introduction to how IRAs invest in this type of thing, and then hand it over to Troy, and we will be off and running. Okay. And thanks everybody for spending some time with us today. I really appreciate it, and hopefully this will be informative for you. So a little bit about me. I've been in the self-directed IRA space for about 10 years. As a professional, but also as an investor. So I'm a real estate investor, both inside and outside my IRA. I also have some cryptocurrency and some agriculture, and I've got things kind of spread out quite a bit. And I guess my point in saying this to you is that I am a self-directed IRA investor like you, or you may be on the cusp of kind of initiating your self-directed IRA strategy. So I'm with you. I understand the thought processes that go with it, the aches and pains that sometimes it takes to get everything set up. But I definitely am engaged in creating a good customer experience, and for you to get the knowledge that you need to make the self-directed IRA investing world accessible. All the information that I'm going to give today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to talk to your financial team anytime that you are considering an investment for your IRA or for your personal finances for that matter. But one of the great things about self-directed IRAs is, of course, that the due diligence process and the strategy process really falls on the account holder. And so that's a little bit of a paradigm shift for some people who have been in IRAs that are a little bit more passive. But you do want to make sure that any investment that you're considering, you are doing the due diligence. Disclaimers are often kind of a throwaway, but this one also points to something I think is important about our role at Advanta IRA, which is that we're a pretty neutral part of the equation. We do not, as I say, give tax, legal, or investment advice. Our job is to listen to what you want to invest in, certainly educate you about the rules and the way that the account dynamics work and things like that, to make sure and document the investment activity that you are creating for your account such that it gets to keep the tax advantages that are associated with the account type. But really, you are the motive force behind this and helping us to understand what you want to do. And then we make sure that the account stays in good standing, again, so that you get to keep the tax benefits of the account type. And at Advanta IRA, we really were built and are built for customer service. So we're kind of a medium-sized company in the space, about $1.8 billion of assets that we do the administration for, which means that we're big enough to have seen pretty much any kind of investment, and also small enough that you can still get somebody on the phone. You know who your account manager is, you know who your education person is, your business development person. You have our phone numbers and emails, and so you do have we create a relationship with all of our account holders. Very long tenured employees. We also do a lot of investment in employee education, so continuing education for us so that we know what's going on in the world of self-directed IRAs, and also to be able to help you with, you know, the rules that are going on for account types and things like that. So anytime that you are considering an investment, and you want to just talk to somebody about, hey, what are the dynamics involved here? What's the timetable? What am I looking at in terms of, you know, fees or any of that kind of stuff? Please do feel free to contact us. Like I say, we're here to be a collaborator with you alongside of the investment strategy that you're looking to create. And let's go back to the theme. The main thing that we're talking about here today is the combination of the IRA or the account types tax advantages with the returns that you can make on alternative investments, quote unquote. And today, obviously, we're gonna have a focus on mineral rights, but there's a lot of alternatives that are available for your self-directed IRA. One of the things that's a little confusing about that term self-directed IRA is that it's not always used the same way. So I will say that a self-directed IRA at a bank or brokerage house like Schwab or Fidelity does mean that you'll get to have some choices in terms of the way that you invest your IRA's funds, but usually it's only in publicly traded securities. So that's their business model, and their value proposition to you is, hey, we'll be the custodian for your IRA, but while your IRA is with us, it can only invest in publicly traded securities because that's what we handle. Advanta, on the other hand, takes almost the opposite approach, which is we've specialized in the administration and the bookkeeping for alternative assets, almost everything allowed by law. And so, we don't sell any assets, and we don't really interact with your decision-making process, except to make sure that it's within the rules and that we can document it properly. So when we offer an account, like any of these account types can be self-directed and be self-directed into alternative assets. So the key for you as the IRA holder is to make sure that your IRA funds are housed or custodied at a provider that handles the assets that you want to be in. So today the combination would be Advanta IRA and investing in mineral rights. So we do handle those with some frequency. So understand that the account types stay exactly the same. So the tax advantages are the same, the contribution rules, the distribution rules, those are all the same as the IRA that you're probably familiar with at your bank or brokerage house. The only difference is, instead of that money buying stock or a mutual fund or something like that, it's going to buy a piece of real estate, or in this case, maybe mineral rights or cryptocurrency or any of the things that are available for IRAs to invest in. And those things, like I say, are myriad. There are all kinds of things. So in terms of the real estate space, certainly there's residential and commercial real estate. Obviously, mineral rights is part of that, that real estate asset class. And there are all kinds of other things and other ways to invest in real estate as well. So there's private equity. So lots of times that's a syndication or some sort of real estate fund. Private debt. So an IRA can be either an originator of loans, or it can buy existing loans or participate in a company via a debt instrument. Cryptocurrency I mentioned, precious metals, all these things are allowed by the IRS for your IRA to invest in. Again, just takes you having your IRA at a custodian that knows how to handle these, the bookkeeping and the administration for these types of assets. So again, today we're going to get to focus on mineral rights and the energy industry. But do understand that there's a pretty broad range of assets that are available to you. And if you'd like more information about that, just get in touch with me. I'm happy to help you, understand what the possibilities are. And one of the things that I find that is as a self-directed IRA investor that I really like is that I get to actually use my existing financial team, my existing real estate team, any of the advisors and CFPs or CPAs that you may have. You can use their expertise and bring that to bear and use that to create earnings for your IRA. So in this case, if you have a real estate team or an oil and gas team that you really that you like and you trust, you get to use that same strategy that you might have used with your personal funds and use it inside your IRA. The key is to just take a minute at the beginning to make sure that the IRA is set up properly, that the investment is documented properly so that you get to keep the tax advantages. But almost anything you know how to make money at outside of your IRA, you can make money at inside of your IRA, again, as long as you take the time to set it up. And it's always a good idea to, have a chat with us about your investment goals and also talk about account types and things like that. From that previous slide or 2 slides ago, you might have noticed an account type that you didn't know could be self-directed, maybe a health savings account, HSA, something like that. So the participation level of each of those accounts, that can be something that we can discuss and have some strategy about and around. And again, it's in conjunction with your existing financial team. And a lot of people will think, well, this is probably a kind of a difficult or a lengthy thing to set up, getting your IRA money at a custodian that handles alternatives, and it's actually not. The most common scenario is somebody will open an account with us. That the application takes about 15 minutes, takes us a business day to open the account. Then we want to move some money in there, and that's typically coming from an old IRA at a bank or brokerage house, perhaps, or an old 401k at a company where you no longer work typically, or other account types, so 403b, 457, thrift savings plans. All these tax advantaged accounts typically can be moved over at one point in time or another, especially if you've separated from employment. It's automatically mobile. So you'll have this new Advanta IRA. You'll roll over some funds or transfer some funds from an old retirement account or an IRA. So then it'll be in the cash position for your IRA at Advanta. It is FDIC insured until such time as you make the investments. And while this process is happening, or even maybe before, you can be looking at investments, vetting them, doing your due diligence, and selecting what sorts of investments you want. And do realize that you can move over as much or as little of your retirement funds as you like. So often people are using their self-directed IRA at Advanta as a diversification tool. So keeping some IRA funds at a bank or brokerage house and some with us to invest in alternatives. So all those options are available to you. And as I say, today, we're lucky enough to have Troy Eckard with us, real estate investor, oil and gas expert, mineral rights expert, and he's going to talk about that specific asset class and see if that's something that might match an interest level of yours and something that you might want to engage in your self-directed IRA. And so with that, Troy, I see that you're back. I'm going to go ahead and share the screen with you. And why don't you go ahead and take it away?
Sounds good. Clay, thank you very much for having us on. I want to say, first and foremost, it's always a very big pleasure to work with Advanta and to work with yourself, because at the end of the day, it is all about relationships. And of course, it's all about working with people that you respect and trust and know. And you and I've gotten to know each other over the last couple of years as we've gone through this kind of change of business orientation where we're working off of Zoom. The one thing I have noticed, Clay, is that either I'm gaining weight on this COVID-19 or I'm getting chubbier in this Zoom meeting, but that's a whole nother subject matter to talk about. First and foremost, for those of you attending today, whether or not you've been exposed to the oil and gas industry, the truth of the matter is that oil and gas is a very intricate part of the overall economy here in the United States, because energy is the driver. And so it's very apropos that as we see rising commodity prices, both in oil and gas, it is very important that we recognize that it is going to affect other parts of our investment strategy. Clay, you still see the screen up as far as the PowerPoint? Yes?
Yes, looks exactly right.
Okay, well, I'm not seeing it on my side, so I'm not sure what I did wrong. But anyway, I'll continue as Sydney jumps in. I've just lost the screen set. So the reason why it's really important is that when you start thinking about rising commodity prices, what you're going to find is you're going to find that it's going to affect your real estate. It's going to affect your stock portfolio. It's going to affect transportation, because we now are seeing natural gas prices today, they're as high as they've been in over a decade. We now see crude oil prices as high as they've been in the last 4 or 5 years. And so we've all enjoyed this really unique growth in the economy, growth in the stock market, growth in our real estate portfolios, because we've had really subdued, we just need to find the PowerPoint. So we found this really subdued pressure from energy that's allowed the rest of our asset portfolio to grow. One of the things that I have found in the last really 2 years, we've talked to thousands of participants that invest in everything, real estate, to hard money loans, to cryptocurrency. They really don't understand oil and gas. So what I'm going to do is walk you through what mineral rights are, how they can be part of your investment portfolio, and most importantly, how they fit into a self-directed IRA. Because when you deal with Advanta and you deal with a professional organization like this, they're simply here to educate you and inform you, which is what I'm going to help do today. And then you get to make the ultimate decision where you drive the car. You're the driver of your self-directed IRA, as many of you know. So let's get started. First and foremost, I'm Troy Eckard. I'm the CEO and manager of Eckert Land and Acquisition. And I have been involved in the oil and gas industry since 1985. I started my career as a young investment broker or advisor in the oil and gas sector, working with high net worth investors. Predominantly, everything I see in the oil and gas investment space requires you be an accredited investor, meaning your net worth is over $1 million or your income's over $200,000. It is because the asset class itself is unique. It can be considered a much higher risk asset class than your traditional public securities. And so therefore the SEC really stresses, and they try to put a lot of emphasis that accreditation as far as an accredited investor is more appropriate for investors in this particular space. Now you can invest as a non-accredited investor through different partnerships and LLCs, but in our case, we only work with accredited investors. I only point this out because as you watch the information flow, you may be deciding that the information is very, very good and helpful, but it may not fit you because you may not qualify. Okay, so let's just restate it again. I've been involved in oil and gas for roughly 36 years. I'm 57 years old. I've got 4 kids, soon to be 8 grandkids. I've been married for 36 years. I'm an overachiever. I feel like I've been doing this for almost 40 years and I should be retired and sitting somewhere and counting my blessings, but I love what I do. I'm pretty active. And the fact is, mineral rights is the lowest risk asset class in the oil and gas food chain. Every oil and gas mineral owner essentially is the landlord, is the one who owns 100% of the oil and gas in the ground. We simply allow major oil companies to develop our mineral rights. So it is a great asset for your self-directed IRA. It is actually qualified under the 1031 tax exchange rules because why? It's real estate. What most people don't understand is that oil and gas mineral rights are in fact classified by the IRS as real estate. So it's appropriate for a tax exchange. It's definitely qualified for a self-directed IRA. What has happened in the United States over the last 15 years is that the US oil and gas industry, by necessity, decided to apply some of the greatest software and hardware technology to oil and gas exploration that we'd never been able to use before. So the same software and hardware that sends spacecraft to Mars, drives your driverless electric cars, handles all these drones, that same data, that same information is now being used to drill wells 1 to 4 miles below the surface, identifying buried oil and gas reserves that we've known for tens of years, tens of decades of years, that we knew the oil and gas was there. We simply didn't know how to drill it effectively, and we didn't know how to extract it effectively. The US is literally saturated with oil and gas. What you see on the screen today is a map of the US. Everything that's in the pink shaded color, darker light, are brand new oil and gas reservoirs and basins that have been discovered and commercially made available to you and I as investors over the last decade and a half. Now, why is that important? Well, oil and gas is all about cash flow. It's all about oil and gas reserves, and it's all about commodity prices. So there's a tremendous amount of wealth created in owning oil and gas interest or assets directly, but now we have the secret sauce. The secret sauce is no longer are we having to really guess where the oil and gas is. Now it's all about efficiency. So one thing I do want to point out to your listeners, Clay, is that whereas before oil and gas might have been something really high risk, really something that was only for the super, super wealthy, the oil and gas mineral rights market has really become an acceptable market for private investors. So just as a reminder, when you think about owning mineral rights, it is the rights below the surface, meaning everything below the surface. It is having to do with anything to do with the natural resource. So you might be in Nevada looking at buying mineral rights there, but those mineral rights are mainly for precious metals. In our case, we're looking at mineral rights specifically for the extraction of hydrocarbons or oil and gas. And the only differential is that the geology, the deposition puts precious metals in one location, it puts oil and gas in another location. So they're both natural resources. It's just one focuses one over the other. No different than real estate. Some areas are great for apartment complexes. Some are really great for industrial buildings. It's just a matter of the same asset class with a different downstream kind of monetary event. But the key is we as mineral owners, you and I, if you invest in minerals, we own 100% of the oil and gas in the ground. We simply sign a lease agreement giving a particular oil company the rights to go develop our minerals, and we get it done for free. Every time an oil company leases our minerals, they assume 100% of the liability. They assume 100% of the ongoing capital costs. They assume 100% of the obligation, and they also assume 100% of the responsibility for distributing all the profit that's made. The good news for you and I as mineral owners is that we end up getting 15 to as much as 25% of all the profit for every drop of oil and every MCF of gas that's ever produced from underneath our minerals, and we never pay a dime for it. So being a mineral owner means your landlord, it's real estate, I'm in charge, I've leased my minerals to an oil company, and now everything that they go spend money on is their responsibility, and I get my share of profit without paying a dime, and I get it every month for as long as those wells produce. So here's what it looks like from a true picture. So on the left-hand side, you see some traditional pump jacks. We've got horses in the middle, I'll explain that, and then you've got what I would call a multi-well pad site. So what happens is that the United States has become so efficient at exploration in the last 10 years. That's why we become the #1 oil producer, that we can literally go take a 5 or 10 acre pad site, build the equivalent of a miniature city. We've got mobile homes for crews. We've got equipment, tanks. We've got 4 drilling rigs actively drilling at the same time. Very, very minimal invasion to the landscape. But each one of those drilling rigs in the foreground is going out or going down about 2 miles in the ground, and they kick off with a curve and they drill about 2 miles out horizontally under the ground. Doesn't affect the fresh water, doesn't affect the ground, but what it does, it is absolutely like a periscope. It is dead on accurate for drilling directly in some of these large buried oil and gas basins. Now, here's the thing that's interesting. As a mineral owner, I don't really have to be in the exact location. I simply have to be in the position of being somewhere within the defined permitted acreage that oil well's drilled in. In other words, I don't have to pick the winning lottery ticket. I just have to be with an expert company like Eckert or an expert company like Eckert that effectively gives you the expertise to tell you how to buy mineral rights underneath proven areas with oil and gas that exist. Now, one of the visuals I like to use is the picture of the Grand Canyon, because we knew these big buried basins were available across the United States. We knew they were loaded with hydrocarbon. We never had a question that they were present. We didn't have the technology to get it out. So we used 2 things. We used horizontal drilling down vertically, then going sideways a mile or 2. And then we used what we call frac stimulation. And the frac stimulation allowed us the ability to go in and basically do a jackhammer. We jackhammer the reservoir by injecting sand and water, and it makes cracks. Those cracks allow the oil and gas molecules to flow. Now I'm setting up the premise of why mineral rights are just now really becoming an investment opportunity for high net worth investors. 5-10 years ago, you'd go try to buy mineral rights and you were really playing pin the tail on the donkey. You hope the geologist would find the right 7-inch hole. You hope they drilled it in the right location. You hope there was enough oil and gas reserves that it made you good economic value. And so to me, buying mineral rights was very much parallel to buying interest in drilling a well. So drilling a well was almost as risky as minerals and vice versa. Today, that's different. Today, when you look at the current screen, you can see drilling rigs all over the landscape. You know you have an underground plumbing system with horizontal wells that's drilling in not just one reservoir formation, but multiple formations that have been buried for millions of years, that have been sitting there. We've known about them. We simply didn't have the technology to be able to extract it. Today, we have the technology. We know where it's at. We know where the basins are located, and we have the sophistication to be able to maximize the production of oil and gas, which means one thing. We went from almost running out of oil and gas in 2008 at 3.8 million barrels a day. We only had 3.8 million barrels a day, but as a country, we were consuming 20 million barrels a day, which is why Saudi Arabia, Russia, and the other foreign producers love Americans buying their oil and gas, because we are addicted to it. We're not cutting back. In fact, we're consuming more. And the reality is we were unable to produce it here in the States. Because of these new shale basins, because of the new technology the last 10 or 15 years, not only did it allow us to go up to 13 million barrels a day in production, which means we were about 4 or 5 years away from being completely energy independent, but more importantly, what we were able to do is take the success of domestic exploration up to about a 98% success rate, meaning every well that's drilled, 98% are successful. Usually it's a mechanical failure if anything happens to the 2%, but more importantly is now, instead of having very few mineral acres in the United States that might hold oil and gas, there's now about 100 million acres in the United States that now sit underneath these big gas basins. Bingo. No matter how much Wall Street throws money at mineral market, no matter how many rich people there are trying to buy minerals, the market has become so large, they now estimate the oil and gas mineral rights market in the United States in the last 10 years is now about a $500 billion market. Most of you are saying, but I don't own any. The reason you don't own any is it takes an expert to tell you where to buy them, an expert to manage them, and more importantly is now The bull elephants, the Wall Street players ran through the mineral market the last 10 years, bought all they could. And now all of a sudden they are waiting for all of their mineral rights to become more marketable, more cash flow. They threw mud against the wall hoping something would stick. That's not how you buy mineral rights. So let's go through it. 4 key successes to mineral rights are simply this. What you want to do is you need to always realize commodity prices is the gas pedal. The engine is the oil and gas itself. The gas pedal is the desire for oil companies to go drill wells. Last year with COVID, shut down, 35% drop in consumption. The Russia, Saudi Arabia flooding the global market with crude oil dropped oil prices to historic lows. One trading day, actually in the negative numbers, negative $37 a barrel. What that did was it derailed the interest of investors and money to put more money in the oil and gas sector. So the only thing that gets anyone interested is profit. We all like to make money. Commodity prices have to be at a certain range, normally above $40 a barrel, for these major oil companies to justify drilling these horizontal wells. Well, until oil prices rose above $40 a barrel, there was virtually very limited drilling activity. What you have to have is a profit margin and an arbitrage that encourages capital to invest. We have that today, and we will continue to have that for the next 4 to 5 years, which I'll touch on in a minute. In addition to commodity prices, we got to have activation. So look at the picture on the screen. You see 3 rigs, they're in 3 separate pad sites. The mineral owners that will be involved in the permitted acreage that each one of those wells is drilling are going to be able to receive monthly checks from the oil and gas that's produced proportionate to what they own. They don't have to get the winning lottery ticket. They just have to be in that unit. But if you look at the size of the landscape in the photograph, there's literally tens of thousands of acres. The only way the mineral rights make any value is somebody's got to be willing to drill them, drill those mineral rights, and produce oil and gas from those mineral rights to create cash flow, to prove up the reserves, which gives you a double value add. I've got cash flow that somebody's willing to pay for and yield, and I also have reserves in the ground that are now proven and de-risked, which somebody's willing to pay me for. The other thing you need is production rates. So like in any investment, the results of your total return on your investment has to do with economics. In our case, we're looking at the fact the oil and gas industry has increased the success of their exploration efforts in these horizontal shale plays by a matter of 300 to 500% over the last 5 to 10 years. What was a good well 10 years ago is a baby well compared to today. So just like Elon Musk with his electric cars and the drones and all the other electronic and software, hardware driven industries, everything that's advanced in those other industries has also advanced in the horizontal drilling. You may not be able to see it from your screen, but there are rails for these drilling rigs. They sit on rails. And what we now can do is we can drill a well down basically 16 to 18,000 feet, 9,000 feet down, 9,000 feet out horizontally. They can lift the rig up on a set of rails and slide it over 50 feet and drill a second well. And they can now move that rig in 6 to 8 hours where it used to take 3 to 5 days. Everything in the oil and gas industry has now become like a manufacturing process. That's why you're not hearing about dry holes, you're hearing about rates of return. And the last thing is recoverable oil. The oil and gas quantity, how many barrels of oil are under the mineral rights that we own, has gone up exponentially as well. Why? The better we drill, the more we stay in zone, the better we frack, the more reserves we get, the higher the production rates means the higher starting point. And so all these factors have gone into making mineral rights that much more valuable today than they were even 2, 3, 4 years ago. And I believe the continued exploration technology success will continue to add to our cash flow and increase the value of mineral rights. So we now kind of have in our mind mineral rights are a great investment. They make cash flow. Let's move into how they work for you as an investor through a self-directed IRA. In our case as a company, I have 36 years of exploration experience. What you see on this screen is you see little flares off in the distance. Those are successful wells that have come online, and as they start to hook them up, they flare off any excess gas. But there's also these little white squares off in the distance, which are future drill sites. So because of technology, companies like Eckert Land and Acquisition can get online. We know where these oil companies have already filed for permits. We know where they've already built gravel roads. We know where they've already put in electrical poles. We know essentially that this army of oil and gas companies is moving months and months in advance of where they intend on drilling, where they intend on drilling not 1 well, but 4 wells or more. And so we use online information and data every day printed and produced by these reporting agencies to understand like the game of Battleship. We know where the ship is, we know where it's moving, we know who owns what ship, we know which oil company is more proficient, we know which wells are producing better. We have so much data today, we can sit in our office in Dallas and really look at an entire basin. Our expertise has been for the last 3 years in Oklahoma, the state of Oklahoma, in what's called the Anadarko Basin, which probably has close to 10 million acres of productive oil and gas minerals. And we're effectively working that basin because we believe a focus and expertise in one market gives you a leading advantage over trying to be diversified across, number of states or number of basins. With the scraping of the information and with the accumulation of the data, it then allows us to be absolutely the most proficient expert at buying the most highly sought after mineral rights in the state of Oklahoma as a result of what we do. We've created a fantastic acquisition team. Now, when you think about a visual, this is always helpful. The bottom part of your screen, you see the underground schematic where the wells are drilling straight down, they're going out horizontally. This is an actual photograph from one of our drones showing a pad site where this oil company drilled 13 wells from this one site. They drilled, 5 or 6 wells to the north. They came back and drilled 6 or 7 wells to the south. They drilled them not in one formation, but in 2 formations. And so all I had to do was understand what this oil company was going to develop, how many wells we're going to drill, run our financial model, and what we determined by owning minerals anywhere underneath any of this particular part of land, we would end up being the benefactor of somewhere between 6 and 13 brand new oil wells drilled with the maximum level of production. And that makes us instant cash flow, 10+% rate of return. Our portfolio the last 24 months, on average, if you invest across all of our portfolios, is averaging about 13.89%, just under 14%. Some of our portfolios have hit over 30% return in a single year. Our financial model only wants to get 10% or higher, so we're way above our expectations. We're doing better than we thought. I'm not selling you on Eckert per se. I'm selling you that minerals themselves are really, really good if you have the idea of owning minerals in the right spot. I'm using only what we've done as an example of the kind of returns you can see. Most importantly is it's qualified for your self-directed IRA. It also is appropriate for somebody who's in a lower risk category who doesn't want a bunch of hidden expenses and costs. They're more in a passive income generation component. So if you can buy minerals, find locations like this, and you put it in your self-directed IRA, you're going to get the benefit of only getting checks every single month. No expenses, no costs, no hidden capital exposures, no fees. And as a result of that, it's a perfect investment for your self-directed IRA. As I move along, I'm simply going to give you just a visual. When these wells are drilled, you can see the little schematic and they go sideways. You're talking about differences in thickness, you're talking about differences in depth. But at the end of the day, as a mineral owner, you own every bit of the natural resources from the surface all the way to the core of the earth. You own whether it's 1 barrel of oil or 1 million barrels of oil. You will always get your percentage of the oil and gas produced because you get it in a royalty. A royalty simply means you pay for nothing and you get a percentage of the proceeds. I love that. I love getting passive income without any exposure or liability, and all I get is a check every month. My biggest fear is the paper cuts I get from opening the envelopes from all the checks I receive. Now, this is an example of how the mineral rights industry has developed and why it's become such a really, really high focus for high net worth investors. Up in the upper yellow section, you see a well that was drilled in 2012. You can see the little black squiggly line, how they did their very best to stay in that formation, in that that gold formation. And because we didn't have the right software, the right hardware back in 2012, this oil company did their very best to stay in the formation that they wanted to pull on gas from. They made a great well, made $4.7 million in 87 months. It looked like a very nice well. The royalty owners made just under $1 million. And that's not a bad well for 2012. Now you come down to the bottom example in the green, 2019, this well was directly offsetting the one in yellow. The oil company now uses better software, better technology. They use triangulation using satellites to keep that drill bit right in the formation. They come in, they drill an offsetting well. They make $5.3 million in 5 months. So from 87 months to 5 months because of technology advancement, which means what? You and I, as a mineral owner, can get our percentage and share of $4.7 million over 87 months, or we can get $5.3 million generated and we get our share of that in 5 months. Now you know why mineral rights has risen to the top of most investors' consideration of investment assets, because now they're starting to see high rates of return, very low risk, continuity of cash flow every single month. It really boils down to 13 things. You're going to get 12 checks a year or 12 deposits in your bank account in your IRA, and you're going to get one 1099 statement or one statement of tax consideration back to your IRA or as an individual investor. Well, who are our tenants? Who's the actual oil companies that we've leased to? In these larger areas, like in the Anadarko Basin in Oklahoma, it's really only major billion-dollar companies that can afford to drill there. So you're looking at companies like Exxon, XTO, Marathon, Derby. These are all billion-dollar plus companies. They are financially well-heeled. They have the best talent when it comes to engineers and geophysicists, et cetera. So what we get the benefit of is leasing our minerals to the very experts that lead the world in global exploration and production. So not bad to have Fortune 500 companies leasing your minerals, and that's who's going to pay you every month, so we know we're going to get paid. So let's talk about a simple explanation of minerals, then we'll get back to clay. Here's what it boils down to. Minerals are real property. They're deeded and titled. When I buy mineral rights for our partners and for Eckert land, we actually buy them from a seller. We've run due diligence and we've checked that title's clear. We then file in the courthouse where the mineral rights are located, the fact that we own them. We make it a public record, and then we send that to the oil company and says, by the way, there's a new sheriff in town. We're the rightful owner of these mineral rights. Here's the date of the executed acquisition. From that date forward, you'll recognize that we're the owner. You'll pay us every penny that we're owed from any oil and gas produced, whether it's one well or 100 wells, and I don't care about depth or formation. Whatever is pulled in natural resources from the mineral I own, you're going to pay me. Minerals have zero liability. What that means is I don't take drilling risk, liability, environmental. I don't pay capital costs. I don't care how low the price of oil and gas goes. If that oil company makes 1 barrel of oil, I get my percentage. So I love the idea of a completely passive, non-liable, zero liability type asset class. It is a passive income investment, meaning that I don't do anything. I've had minerals for 30 years. All I do is open up the envelopes and put a stamp on the back of my check or go straight to my account, and then I get my 1099 at the end of the year. So for me, I can't find another more passive income generating investment than owning mineral rights. They're easily bought and sold. You can get into them, you can get out of them. There's a very large market that buys and sells mineral rights. These are sophisticated buyers and sellers. And then what you have to have is the idea that it's about, your property. When do you want to sell? When do you want to hold? Most of my partners like to buy them because they consider them legacy assets they can give to their kids and grandkids. Why is that? Because they know that all it's going to do is generate cash flow without really any decision making and any liability. So it's a great legacy asset to pass on. They're held forever until you decide to sell them. And at the end of the day, it's about wealth building and generational asset pool. Now, most of you are involved in traditional real estate. So you're looking at apartment complexes, self-storage, residential assets, maybe industrial buildings. And I'm just giving you a simple list of, what are we looking at? In the state of Oklahoma, I don't pay any property tax. I have no holding cost. I don't need to pay repairs, insurance costs, utilities. I don't have any employees. At the end of the day, what it really boils down to is the lessee, meaning the oil companies who've leased the minerals that we buy, take on 100% of that liability, and I don't have to pay any of it. The only thing we have to pay from our mineral rights is we pay our share of production tax that goes to the state that we're in. They want to make sure they get their share of the taxes, which is like 6 to 7% of our gross income. But that's going to happen in any state. But as far as a comparison from traditional real estate, we really have zero holding cost. Now, I want to remind you, zero capital cost, zero risk. Very important. Very, very safe investment. Exactly the kind of investment you want to put in a self-directed IRA. It's about cash flow. It's about knowing that once you buy the cash flowing minerals, by the way, I'm advising, don't go out and buy speculative minerals. Don't say, well, a producing mineral is 10,000 an acre, non-producing close by is 3,000 an acre. You might own that non-producing mineral for the next 20 years because it is not going to be drilled, which is activation, not going to be drilled by an oil company today, tomorrow, in 5 or 10 years. So from our position, advising or at least giving you educational information on this presentation, I would only be interested in buying mineral rights that are under proven producing cash flowing wells, because I don't have the ability to tell that oil company when to drill, how to drill, or how many wells to drill. So from that standpoint, I'm only interested in cash flow, preservation of capital, passive income generation, and the ability to see my mineral rights that I buy go up in value, because every time they drill a well, they're proving more reserves. Last but not least, this is about you and I. We're all getting to the age and we're all getting to the position where this crazy economy, we want inbound cash flow and no outbound. I don't want to repair sheetrock. I don't want to go repair toilets. I don't want to have forbearance on my tenants. I want money and I want cash flow to allow me to live my life, watch my portfolio grow with as little headaches or any kind of expenses out the door. It is perfect for an IRA in that really your IRA, self-directed IRA, will simply get checks and deposits every month without having you to come up with additional fees or capital calls, etc. So let's talk about it. Passive, profitable, long-term. It probably is the most passive income generating asset in the entire asset class market. What I want to remind you is there are a lot of people who offer oil and gas mineral rights. In fact, there was a company last year that was offering oil and gas mineral rights. They put them in partnerships. And after 3 years, they came out and said, really, we're a Ponzi scheme. And as a result of that, that passive investment became really passive because they didn't buy anything. The way I would suggest that you take from this particular presentation is the following. Use your common sense like you always do. Do a background check on the people that are offering you any type of investments in oil and gas. Use common sense. If something doesn't add up, it doesn't add up. Know that mineral rights are deeded and titled. The way we do it is we sell our partners direct oil and gas mineral rights, meaning that you have an exhibit, you own it, you get copies of the deeds and title. I personally don't like partnerships or LLCs. I want to know that it's my asset that I own. I want to be involved in a situation where the promoter, the sponsor that is offering it has a long history of experience and expertise. And so you add all those common sense things that are normally talked about on Advanta and in the educational efforts that go across all these different platforms. It always boils down to the same thing. Know the management team, know their track record, know who they are, make a decision on the asset class, tiptoe lightly, get to build a relationship, and then decide how you're going to invest. Today, this investment, this asset class is a perfect match for a self-directed IRA, and Advanta obviously is the place you want to open that account with. Clay, I'll turn it back over to you.
All right, thank you, Troy. I appreciate that. And one of the things that this is interesting that you kind of wrap things up in a way that on an issue that I get asked a lot is, so people often say, well, you know, I like this idea of self-directed IRAs, but man, it's nice to not have to do a lot, to be thinking about it all the time. And so one of the things that I'm always explaining to folks is that the amount of effort that you need to put into particular investments really depends on the investment. Now, I personally would say that to get your self-directed IRA started, you're going to need to invest a little bit of time, understand what's going on, do some research. But
Right.
there are a number of assets that can be pretty passive, and this one is the first time that we had a presentation like this. I was stunned at how logical that was. That it's really a pretty passive exercise. So
Yeah, one of the things I've noticed, Clay, really is probably been, I think, because of COVID. I don't know why, but everybody's kind of changed the importance in their life. You know, before, you know, I'm a wealthy investor and I got my business, my practice, I'm buying rental property, everybody was busy, busy, busy. And all of a sudden you get locked down in your house for 9 months. You start going, well, I haven't seen my mom in 9 months, my family. And I think people have gotten almost sentimental, not only as far as the relationship, but sentimental in my time is worth more than maybe a little extra profit. So in the asset classes that I see them choosing, I'm doing this myself. In the asset classes I'm seeing, I'm looking at somebody saying, hey, Troy, I want you to do this startup or invest in this or do this or this. I'm like, what's it going to require my time? Because I don't have any more time. And I'd rather spend it with my family or my kids, or I'd rather be vacation or in my, you know, out of my house in Colorado. So when you think about going out and buying 10 more residential homes or trying to track down different investments, I think there's been a huge switch over where people are saying, how can I put my money to work, try to find a yield above inflation? What's going to be the least amount of checks I've got to write? I just want to enjoy life. And I think that's where I think a lot of our clients, we've had a record year last year and this year because of that exact reason. I want to invest in minerals. I want you to send me a check. Troy, you take care of the management side. Just let me know how much money I made this year because I really want to go sit at the beach in Hawaii or wherever. And that's what I think has been the stress that most of our clients have said is we want simplicity and income. It's those two things combined.
yeah. Well, we do have a few questions if you got a second here. So we're going to answer a few questions. If those of you are still on the broadcast, if it's time for you to go, I hope the information was helpful for you. And if you can stay for the questions, please do. And if you have questions, type them into the questions box and we'll sit and answer them here for a moment. Okay, so first one, how do you compete with the oil companies themselves getting leases on the property they're working and the owners of the property and as well as competing with the owners of the property just keeping the mineral rights? How do you compete with those guys?
It's a great question. We don't compete with them. Remember, the oil companies are our tenants. We're the landlord. So, just like if you own an office building, I don't compete with my tenants. I'm trying to find it's kind of like a class A building and a class B building, right? So you want to go out and buy an existing commercial property and you find out that, Facebook is your tenant. You go, well, that's a class A tenant. They're always going to pay rent. Well, you're going to pay a lot more for that building because, not only do you have a good tenant, they probably have a long lease and they're going to be there. So we don't compete with the oil companies on the leases. We sell them leases and they pay us 3 years lease bonuses up front. But the way it works in oil and gas is as follows. When the minerals are leased to a specific oil company, that oil company has 3 years in which to start, commence exploration. Once they've established a producing well, they now have earned the right to continue development in perpetuity as long as they continue to prudently develop the minerals that we own. So we don't compete with it. The way we buy minerals is simply this. It's no different than your normal real estate portfolio. You got a guy, let's say you have a farmer in Oklahoma. He owns 300 acres. His grandfather left him the property. He needs to buy a John Deere tractor. He doesn't want to sell his 300 acres surface rights. So what does he do? He goes, well, I own 300 acres of surface, I own 300 acres of mineral rights. What if I sold 50 acres of mineral rights? I still own the other 250, but I can generate $10,000 an acre because that's what they're worth, or maybe 12 or 15,000 an acre. All of a sudden, I got $500,000 to $750,000 allows me to buy the tractor, pay off my farm, and I still have 250 mineral acres. The other scenario that happens is that over the last 150 years, these heirs inherited all these mineral rights. So John gave it to his 4 kids, he gave it to his 4 kids, gave his 4 kids. All of a sudden, Susie, the great-great-granddaughter, has no clue she owns 10 mineral acres in Oklahoma. The oil company can't find her. Nobody knows how to get hold of her. Well, now because of technology, we can track back and we hire professional landmen that finds Susie Smith, living in Seattle, Washington, is the great-great-granddaughter of John Smith. Think about the commonality of the name. We contact her and we say, Susie, we're Eckert Land and Acquisition. We noticed that you own 10 acres of minerals in this county in Oklahoma. And the first thing they say is, I do? Yes, you do. Your great-great-grandfather left it to you in a will. And well, really, what does that mean to me? Well, we would like to make you an offer to buy your mineral rights. You own 10 acres. Well, how much are they worth? Well, we'll give you an offer of $100,000, $10,000 an acre. We know you own it. That's why we called you. And we can bankwire and close with you in 7 days. Oh, absolutely. Tomorrow. Send me the $100,000. I can't wait. So what's happened is these mineral rights have been dispersed over this lineage all over the place. They either don't know what they're doing, don't know what they own, or the immediate cash is more important than anything else. So we utilize professional landmen to look at every mineral section where there's an existing producing well, no speculation, and we find out how many minerals either need to sell, want to sell, rebalance their portfolio, or have no clue they own it. Recently, Clay, what's really happened is these big major private equity groups came through in the last 5 years. They bought 10, 20,000 acres at a time. Now they need to rebalance their portfolio. They pay 2,000 an acre. We know it's worth 20, and they're willing to sell it to us for 8, 9, 10,000 because they've already made a great profit. But just like you as a real estate investor, bought the house for 200,000, now it's worth 400. You sell it, pocket 200. Now you buy 2 more houses. It's about rebalancing. So even in the mineral rights, everybody is rebalancing their portfolio. We simply happen to be a very specific strategic buyer, so we know what we want, and we use that arbitrage to find what we want at the right price.
Next question is, where do we find the smaller buyers and sellers of mineral rights if we want to deal directly with the owners? Where would you want to market a small amount of rights to a retail buyer in the $100,000 to $500,000 range?
I'm not understanding the question. So if I understood right, you mean, how do you find smaller mineral sellers?
Yeah, if somebody has mineral rights and they wanted to do it on their own, what does that marketplace look like? What are dynamics?
Are they trying to buy them or are they trying to sell them?
It says, where do we find smaller buyers and sellers?
Well, I call that secret sauce. The secret sauce is, so I'm not going to give you the answers to how to compete with me, but I will tell you this. You can literally walk into a truck stop in Oklahoma on the way to the men's bathroom, and there's a bulletin board, and you pull off a ticket that says, we buy mineral rights, or I sell mineral rights, right? So if you go online and put in mineral rights, you're going to find 50 to 60 mineral rights experts. What they are they're aggregators, and they want you to get online, fill out their form. You're going to tell them you own 5 acres, and they're going to make you bottom dollar offers for your minerals because they realize that you went to them because you don't know what you're doing and you're probably not sophisticated. So you would have no clue it's worth 15,000 an acre and they're going to offer you 5,000 an acre, because I get those letters and offers all the time because they don't know I'm in the business. So you're going to have to really figure out, if you own minerals and you want to sell them, you have to do some research to figure out who truly is the best way to exit or sell those mineral rights. Okay. The flip side of that is, if you want to buy them, you can buy, literally, you could get off this line and probably go to Craigslist or anywhere you want. You can buy mineral rights today, not even accredited. You can buy mineral rights for $100 an acre, because what you're going to buy is, where it's like buying scrub brush in West Texas. I can buy land for $1,000 an acre. A goat couldn't live on it, but I own an acre in West Texas. This is not about the ability to buy and sell. It's about buying the right minerals in the right spot with the right activation. And as far as selling, you've got to decide for yourself. You got to know about your own acres. Where are you? Are you in the trend, out of the trend, on the edge of the trend, in the heart of the trend? And my guess is, if you own small acres and you haven't been contacted yet in the last 5 years, you're probably outside the trend. Doesn't mean you can't sell them, but I guarantee if you're anywhere in the heart of the trend, you've already had 20 letters and 50 knocks on the door, because we all know where the acreage is. It's just a matter of finding the seller and getting him to sell at the right price. But you can go online and find a lot of that data out, a lot. But I won't tell you the secret sauce.
Next question is, how do you see the long-term viability of the oil market with the utilities and transportation sectors moving away from hydrocarbons?
I find that last part a joke. So here's what I'll tell you. So Elon Musk makes all these electric cars, and the state of California wants to get rid of all natural gas in the next 15 years, 10 years. And everybody's going to go hug a tree and scream, Green Deal, Green Deal. And the truth of the matter is that right now we're almost back to pre-COVID consumption and increasing. We now are 22% less output of oil in the United States than we were before. We have a current administration that did everything they could since January to derail the current exploration of this country, and then followed it up 3 weeks ago by begging Russia and OPEC to produce more oil because we need it. So here's what I'll tell you. The only way that statement makes sense is that anybody who believes that we're going to get away from hydrocarbon in the next 20 to 50 years is the same person who would protest that fossil fuels are creating climate change, but they're going to have to do it on a dirt road, butt naked, with no clothes on and no sign, because everything that paves that road, creates that sign, the ink on the sign, and the clothes you wear, and the phone you use is made from petroleum oil, right? So the key is, let's talk about practical. So here's what I think is going to happen, Clay. We're going to have an increase in energy demand as the population goes up, as we have consumption go up, and we have more manufacturing. What really is going to happen is alternatives are going to take a percentage of that additional energy growth, but oil and gas will continue to stay as it is, and the oil and gas consumption levels will go up, but maybe not take up 90% of future growth. It may take up only 75% of future growth. So oil and gas consumption will go up, but the extra 10 or 20% of energy consumption, maybe oil and gas only gets 65% of that additional growth. Does that make sense? Because the idea is, we're never going to survive as a country if we don't have the same consumption level of oil and gas we have today and increase. It's just we won't get as large a share of that future energy consumption.
Yeah, so I think to paraphrase what you're saying is that the consumption part is still going to be, the gross consumption is still going to be increasing for quite a while because of the way that the world works, essentially. Is that right?
Well, I don't know how it is where you're at, but I'm looking at the Dallas-Fort Worth market we're at. Unbelievable housing going up, highways double, triple. We got construction crews building highways. You were talking about a $3.5 trillion infrastructure project, maybe a $500 billion to go toward true infrastructure. But what they're talking about is building new highways, bridges. They're talking about going out building dams and lakes. All that comes off of fossil fuels. And so the truth of the matter is that the same administration that doesn't like fossil fuels is talking about spending $3 trillion on fossil fuels. The same administration that was talking about cutting back on hydrocarbon use just dumped $2 trillion, said go buy yourself a travel trailer and a boat and cars and take trips and do all the things you want to do. So the key is what you said, which is the consumption today is about 20,500,000 barrels of oil per day. We only produce 11.5 million barrels a day. So we're asking foreign producers to give us 10 million barrels a day. You go to Saudi Arabia and Russia 3 weeks ago and say, please give us more oil. They go, no, that's all we've got. Because what happened is last year, Saudi Arabia and OPEC, when they decided to flood the market to cut our legs out from under us and make the price drop, they didn't go get it from wellheads. They didn't drill new wells. They took it out of their strategic reserves. They temporarily pulled from the reserves, flooded the market to crush us. So let's talk about what that means. If we're at 11.5 million barrels today in output in the United States, producing ourselves, but we're burning 20.5 million, we're 10 million barrels short. The production output is going down, not up, because there's not enough wells drilling and nobody wants to invest in oil and gas because they're all considered, you got to go invest in green energy. Pension managers are telling their pension funds, do not invest in fossil fuels or we'll pull our money away. So we have a complete withdrawal of capital into the energy sector. That's fantastic news for those of us that own mineral rights. That's fantastic news for those of us that own oil and gas directly. Because why? The less you drill, the less we produce. In concurrence with the rising demand, that's economies 101. Increased demand, lower supply means higher prices. Today we're at $73 a barrel. Natural gas today is almost $5.60, which is about the highest it's been in 12 years. So what I'm going to tell your listeners and your viewers is the following. I'm not looking at oil and gas being anything less than a growth market the next 2 to 3 decades until somebody comes up with a viable solution for alternative energy that can be produced on a mass scale, and it doesn't exist today. What I do know is we just won't get 100% of future growth. We may get 75%. I welcome electric cars. I welcome alternative. I want solar to work if it makes sense. I want wind to work. I hate the windmills. They're ugly in the sky, but I want them to help, because the truth is we are in desperately short need of more energy in this country than we can produce because of where we're at today. What drove the economy last year was cheaper energy. I want cheaper energy, but we're not going to see cheaper energy for the next 3 to 5 years. Everything in the market today says oil will be over $100 a barrel, and natural gas is going to set not new records. We're going to be as high as we've been in 15 years. I want to own producing wells. Right now, we have over 500 producing wells that we've acquired in the last 18 months, and our checks just keep getting bigger and bigger and bigger. It's not us that's doing it. For those that are listening, buckle up. Your electric bill is going to be up 30 to 40%. Gasoline at the pump is going to be $5 to $7 a gallon and higher in states that have all their extra taxes. There's nothing you can do. We just had a Category 4 hurricane destroy half the Gulf of Mexico. Well, that's 17% of the U.S. production. Second storm came through 3 days ago, knocked out all the natural gas. You want to know what we're going to see? We're going to see the effect of storms and winter and geopolitical pressure. And guess what? We're in a super cycle for rising commodity prices. I want to buy today, own today, because the U.S. only has so many wells. They can give up so much oil and gas, which is barely 50% of what we consume. It's an incredible market. I mean, I've been doing this for 36 years. I couldn't be happier that COVID occurred, not for any health reasons, obviously, because the market, I couldn't be any happier because it caused the demand to go down. It crushed the supply side. So if you were able to take advantage of the market, buying minerals has been the best investment I've done in 36 years, and we've just started. So it's super exciting.
Next question. Would self-directed IRA and mineral rights trigger any Ubit or UDFI taxes? No. UDFI can only occur, obviously, if you're using debt financing, and royalties is actually one of the it's one of the exceptions in the Ubit rules. Ubit comes. Most of the rules were created for nonprofit organizations, but it's specifically listed in there that royalties are considered to be passive and don't automatically have Ubit associated with them. So
yeah, and what you
absent any debt, you're in good shape.
And what you said is really critical. You really have no decision to make with your mineral rights. You don't get to tell the oil company when to drill. The nicest part about this is I'm a type A person, if you can't tell, right? I don't sit in the back of a car without telling somebody how to blink or how to turn. With mineral rights, all you type A investors, you don't get to say anything. All you get to do is deposit checks every month. That's one nice thing, is you have no stress, but that's why the Ubit doesn't fit, is that it's 100% passive.
Okay, and so we're close to time, but I wanted to just ask one other question that had come up from a previous episode that we did. So sure. Can you describe just a little bit of what a typical life cycle of a mineral rights investment is? When is it produced? Does it go dormant? What do you do with it then? A little bit about that.
Yeah, it's real simple. In the areas that we buy minerals, which is going to be pretty predominantly, most of the mineral rights you see are going to be in these shale basins. If I were to buy if we were to invest today, let's say everybody on the screen decided, hey, we're all going to get together and put in $100,000 in our self-directed IRA. We're all going to go buy some mineral rights in Oklahoma underneath producing wells. We'd buy it today. We would close. We take that title and that deed that we've acquired. So our effective date would be today, September 15th. We would ship that deed to the courthouse, get a courthouse stamp saying it's now been recognized as a transfer of a real piece of property. We'd get that back in 45, 60 days because the courthouses are a little slow because of COVID. We'd send that to our tenant saying, oil and gas company, Exxon, Chevron, Marathon, we're the owner as of September the 15th. They would then run it through their land department to verify that we own what we say we own. It would pass for the accounting department. The accounting department would look at it and say, yep, now they're in pay status. Their pay status started September the 15th, so whatever oil and gas was sold as of September 15th. And we'd get a check. By it September 15th, our first check will probably be in January, February, 4 to 5 months. And that's just the process of handing paper off, right? Once we get the check, Clay, at that point, the check comes every month, every single month for whatever oil and gas is sold. Now, your life cycle can be the following. You can just say, I'm going to pocket that mineral, put it in my account. I never have to worry about expense. I'm going to own it forever. These wells will last 25 to 50 years. More importantly is in the area that we buy minerals, these things are like buying a pen of pregnant rabbits. So if we buy them with 1 or 2 wells, we only bought it or acquired those minerals because we believe there's probably going to be closer to 10, 12, 24 wells. So we'll have income for the next year or 2. They add 2 more wells, our income's going to go up. Those wells are produced, they'll add 2 more wells, income's going to go up. So really, if I'm just a buy and hold kind of person, I'm just going to have checks for the next 25 to 50 years, which is what I've been doing since 1985. I still got mineral rights, give me checks after 20, 30 years. Now, if I'm more of a asset allocator and I want to look at timing and maybe I want to liquidate some part or all, I would say that in the way we do minerals, same process works, checks start coming in 6 months, but I'm going to be looking at commodity prices and market demand for cash flowing yielding assets. So our strategy here at Eckert is we're aggregating and buying now. We're going to let those assets mature between now and probably the end of 2023, early part of 2024. And I believe every pension fund, every money manager out there is going to be desperately trying to find assets that can generate more than inflation rate. And they're also going to be looking for places to park money. Well, we will be sitting on a bunch of wells, 500 to 1,000 wells that are generating flush high-end production, generating $100 oil and $6 or $7 natural gas. So we'll be at the peak of revenue, peak of demand for interest-bearing assets. I am personally looking at liquidating 1/3 of my portfolio. I think I can get 2 to 4 times what I paid for it, take all my money off the table, put it back in my self-directed IRA. I still own 2/3 free and clear and go buy some more minerals. So the life cycle is really about your choice. Long-term hold, short-term reallocation, but either way, you've got the choice to do it with some part or all of your portfolio. It's your choice.
Got it. Well, thank you, Troy. As always, very informative. Love having you as a guest. I appreciate your sharing your expertise with us. Hey, if somebody wants to get more information or get started with you guys, do they just go to elaminerals.com? Is that the right place to go?
You know, I'm a pretty brave soul. Here's how it works. My cell phone number is 469-422-1781. 469-422-1781. You can call me, text me. We have a wealth management team. They're not paid commission. They're not salesmen. They really work with high net worth investors about properly allocating wealth. You can always go to our website at eckertenterprises.com or elaminerals.com, or you can call the 800 number at the office and ask for a wealth manager at 800-527-8895. 2 things I'll leave you with, Clay, as we part is that, look, don't be foolish with your money. Clay and Advanta are tremendous at providing education information, but whether it's traditional real estate or oil and gas or Bitcoin, there's a lot of sharks in the water, and you got to work with people you trust and you know. I grew up in South Texas, 6 miles off the Mexican border, and I should talk like a Texan, really slow and act like I ate a bale of hay for lunch. But the truth is, my brain works in overdrive. This is natural. This is not cocaine or drugs. This is Troy on fire because I love what I do, and I've been this way since I was born. But I'm going to tell you right now, we're in a very chaotic economic market. There's a lot of factors that are starting to tell you to start being concerned about inflation rising, the stock market, and real estate. And so I'm finding, Clay, most of my big clients are going to firms like Advanta and saying, I better reposition assets. I better open up some accounts. I better pull some stock out. I better take control of the steering wheel because we may be headed into a little bit of a very, very bumpy road or maybe even a brick wall we slam into. So I'm encouraging those of you that are listening, if you haven't opened an account, get with Clay and open one and start directing your IRA. Don't sit back in the passenger seat just assuming they're not going to hit the brick wall. It's too late to jump once they get close enough to hit that wall. And I think that's the key thing is use Clay, use Advanta, be smart, take control of your assets. You worked your whole life to create it. Don't take a couple of months to lose it if the market turns south on.
All right. Well, again, Troy, thanks so much. Thank you, everybody, for joining us. And you have our contact information. So please, if you have follow-up questions, we're happy to answer them and be a resource for you. So thanks again for taking your time today, and have a great day and happy investing. We'll see you on the next one.
Thanks, mate. Take care of yourself, buddy. We'll see you.
Yeah, we'll see you.